Riot Platforms, ticker RIOT, grew revenue 36% a year to reach $647.4 million, while losing 122% on every operating dollar. That kind of loss comes from a company that mines Bitcoin around the clock from data centers in Castle Rock, Colorado, with a smaller engineering arm building power distribution equipment on the side. The stock actually rewarded patience over the past year, up about 51%, but it swung from $11.30 to nearly $29, with a drawdown of almost 49% along the way. A beta above 3.7 versus the S&P 500 means this stock typically moves nearly 4 times as hard as the broader market, in both directions. Profitability shows the same extremes. Gross margin is a healthy 28%, but operating losses and a net margin near minus 196% show how much gets eaten up by mining costs and depreciation before anything reaches the bottom line. Return on equity of minus 48% and return on assets of minus 21% confirm the company is still burning through capital to grow. Earnings per share actually turned positive in 2024 at 34 cents, only to swing back to a loss of nearly $2 a share last year, a reminder of how unpredictable mining economics can be. Free cash flow has stayed negative throughout, ballooning past $1.5 billion in 2024 before easing slightly to around $1.14 billion. The balance sheet looks steadier than the income statement suggests. Assets of nearly $3.9 billion dwarf liabilities of about $1.1 billion. Cash sits at $233.5 million, and a current ratio of 1.585 with debt to equity of just 0.4 suggests the company isn't at immediate risk of running out of room. Valuation is where it gets interesting. Riot trades at about 10.3 times sales and under 3 times book value, cheaper than IREN at over 20 times sales, Applied Digital at 14 times sales, and TeraWulf at nearly 50 times sales with a deeply negative return on equity. On these multiples, Riot looks like the cheaper way into this sector, even with its own steep losses. Momentum has cooled lately though, with the stock below its 50-day average and an RSI near 40 suggesting sellers have had the upper hand. The tension is clear, fast revenue growth and cheaper pricing than its rivals, against a company still burning enormous amounts of cash to get there. If you want more breakdowns like this, subscribing helps a lot. Drop a comment with the next company you'd like covered. And to be clear, none of this is financial advice. Always do your own homework before putting real money behind any of it.